Welcome to the Weekly Notebook Review. I am Robert McGroarty. This podcast takes on a bit of a different format where we are live each week on Twitter Spaces. I crack open my notebook and review Hedgeye research with anyone who wants to learn a better way to invest. We feature both Hedgeye power users as well as some special guests that might pop in. If you want to learn more about our research, visit hedgeye.com. If you'd like to participate in the live stream, follow me on Twitter at HedgeyeRJM. Now, let's review the data.
Hey, Robert. Nice seeing you after Hedgeye Live.
Hey, Roland. How are you doing?
Not bad, not bad. It was really good meeting everybody again.
Yeah, it was. I agree. Always a good time. It's a great crew. I liked how Keith, Coach, kind of coined it the Power User Conference. I think it's a great way of thinking about Hedgeye Live. You want to be a
Absolutely.
power user or be around people that are power users. It's whether you're institutional or an investment advisor or just a regular old person. There's a lot of value there, especially in between the macrocosms and the sector head, discussions and all that kind of stuff. It was wonderful.
Absolutely. Shout out to George and Leslie. Sorry, missed you guys.
Absolutely. They were definitely missed. And Trend Wizzo.
And Trend.
That crew from last year. It was a great crew, and a lot of folks that I know couldn't make it this year. Like Blake, like Blake and John Weeks, and anyway, there's a whole list there. But you're all loved and you're missed. But we'll get let's get into the notebook review here. It's Wednesday. We're May 10th. It's game 89. This one, I guess, goes to the Bears, to the Bulls, a little bit, but didn't close. The NASDAQ was up a point. S&P was up about 45 basis points, and VIX, pushed lower, but really couldn't quite get to the low end of the risk range, which was 16.13. And so we'll call it for the Bulls, but it was kind of up and down and a little bit all around. We definitely were at some key levels. The VIX to me is a really interesting one here, putting in another, kind of like a higher low, right? That low from on the 1 month basis is down from the end of April there, Friday, April 28th, which was the month end. That low closed at 15.77. So that's the most recent 1 month and 3 month low. That should be kind of written down in your notebook, or certainly that you should kind of have on your mind. So kind of as we put in higher lows here, again, that top of the risk range, that low end of the risk range, which I just mentioned, which was 16.13. That's clearly well above that prior number I just gave you. So again, these higher lows, and we did get a bit of a consolidating range on the VIX today, which I thought was interesting because it did kind of expand a little bit yesterday. I think the top end was closer to 21 and change, if memory serves, 21. 21.13. So we kind of came in under 20, under 21 today at 20.85. But if we get up there, that would be a new 1 month high. So again, this is kind of like the way that I think about things as you go through the notebook and writing down these risk ranges or reviewing the risk ranges. However you do that, just being conscientious of where the kind of historical price closing prices are, because that's the key piece of the price, volume, and volatility, and it's all about the closing numbers. Just kind of understanding where those are on a kind of 1 month look back and the 3 month look back. Again, trying to think about trade and trend. So 21 day would be the trade. 63 day would be the trend basis in terms of your general look back. Now, again, that varies by asset class, but just generally thinking about those things, I think that's an interesting setup on the VIX to me. Not just to me, but that what that signal tells me is that we're going to have a harder time getting a lower VIX, and so this low end of the risk range is 16.13. If that holds kind of up here, and it's possible it moves down a little bit to tomorrow's risk range, just given where we closed today. But if we close in here and kind of keep this, Keith mentioned it on Macro Show today, how volatility is kind of really has come out of a lot of assets. Like FX Vol was an example he used this morning, where it's under that trend level of 9, where it closed yesterday at 8.89. I don't have that updated number yet, but the VIX, the RVX, Vixen, they're all, Vixen is, closed under 20 for the first time in quite a while. And with that, that's actually a new closing low. So kind of the Vixen and the VIX look a little bit different. So again, these little nuances are certainly things that, folks should be paying attention to. And again, this Vixen closed down sub 20, definitely has a kind of correlation, to that IXIC, aka the NASDAQ composite, closing at, recent three, new highs on a 1 month and a 3 month basis. So these things definitely get, again, as I said, these things have the correlations. They factor into our VASP signal from Keith and Hedgeye in regards to price and volume and volatility. That Vixen looks a lot different than even RVX, which again, it did close lower today at 22.76 is where it closed, but that's another, higher low. So that RVX and VIX look a little bit more similar in terms of how they're acting at the moment. The RVX low again was from the end of April, which closed at 20.81. So these are kind of, again, just kind of to write down these numbers. We're going to be conscientious of these numbers. The broader stock index in terms of the Russell 2000, that looks a lot different than the NASDAQ and the spot and the SPX. So in terms of worst signal, it would go Russell, then SPX, and then NASDAQ. So I just wanted to kind of touch base on that. That was a big thing that I wanted to review today. But Roland, since you're up here, you're not often up here, Roland. So I appreciate you making the effort, my man. But what did you see out there today? Did you get a chance? I know I don't know if you were kind of busy with the day job, because I know you're a nurse. But yeah, were you kind of in the seat today, or a little bit busy?
Yeah, definitely back in the saddle a bit today. I successfully tied myself up, and it's just sometimes good to just start over again. So I really enjoy the Macro Pro, where Keith's account is showing how things move along. And when you're familiar with the position sizings according to what sector he's buying in, then you know that it was a 3.3% minimum that he went in the day before yesterday. And that's why it jumped up the scale on a few people. I'm not necessarily going to just put that out on Twitter, the obvious, but it's really nice to have validated also through the macro show what percentage he's at on some of the key investments. It's been nice to watch, more green, and it's comforting on my process, so then I can develop how I'm going to document and observe and watch the market play out, so I can actually see the vivid displays of changes that are ongoing. It's really, really a great tool, Macro Pro. I really like it.
Awesome, man. I appreciate that. And yeah, so what Roland is, for those that don't have Macro Pro, what he was referring to is more some of the newer fixed income exposures, which I've alluded to on Twitter, and I believe Keith has as well. And just at the minimum sizing, right? And so, taking it to the minimum size, but again, just like everything that we do, you got to remember to volatility adjust those sizings. So those max longs, which, in a typical environment for fixed income would be a max of 10%. They're significantly smaller with the move, which closed down today, which was, I guess, good to see. But still elevated. So closed at 125, but still elevated from a historical standpoint, and therefore that's influencing the sizing, the max sizing that one would have on in your fixed income position. Keith did give the trend level there on the move, and in order to get bigger in fixed income in general, especially things like IEF or TLT, you really need to have that move start to break down and try to certainly make new 1 month lows, which are down at that kind of was it just sub 120, I think, or around 120, 119. Yeah, 118 spot 84. So kind of make one new lows there on a 1 month basis, and really want to try to see that on a more trending 3 month basis as well. And it could happen because those lows from back in early February, where we got down to kind of that 100, 102, 105 level on the move, those are going to start to kind of fall out of the look back. So you're going to have kind of, generally either perhaps a little bit of a consolidation, or certainly it makes it easier to sort of make new lows, and for that to happen. So be conscientious there. Interestingly enough, though, the 10-year, again, narrowing risk range this morning, and that's been a bit of a shift in the last week from when we were talking, last week and some of the weekend work over the weekend. We were focusing more on the kind of belly of the curve, that's 7 to 10 year, versus the longer end and the longer duration. So it's currently looking a little bit better. Narrowing risk range there, narrowing risk range on the dollar, narrowing risk range on the euro. You've got a narrowing risk range on crude, even though a big lower high as well for crude pricing. The gold on the other hand is a little bit of a widening risk range. So you got a lower low this morning and a higher high. That higher high is at 20 spot 68. And really that's kind of a bit of a reflection more on the volatility there. GBZ's up at kind of like around the 19 level, or at least it was this morning. Where it closed today, actually. Look at that when we came on. Yeah, so basically same spot, 18 spot 37. So just that slightly higher elevated, volatility is going to, give you just a bit of a wider risk range. That is kind of a little bit higher on a week-over-week basis, but is down on a month-over-month basis. But again, this volatility, if it's not on your screens, it really should be. We provide all that kind of the core volatility data that you should be looking at in the macro show deck. So again, just make sure that you're kind of, writing down that. Roland, that was certainly, you were sitting next to me on Saturday afternoon, and that was something that we reviewed in terms of what goes into my notebook. And as you know, or as you saw, I guess, with your own two eyes, I write down all of the volatility components, along with the US 2-year, 10-year, and the yield curve. So that's just one piece of the puzzle that goes in the notebook. But we had a good session there that Saturday afternoon, just kind of talking through, how we think about some things. So that was a lot of fun. But
Yep, absolutely. And the volatility indices that are featured in the macro show and in the slide deck are much easier to follow and more graphic than they ever been. Last couple of years, they've had some nice improvements in that.
Yeah, agreed. Yeah, big. All right, so we keep kind of rolling through here. In terms of opportunities that were on the board today, you saw a coach, or if you get RTAs, he hit the button on the short side on Amazon. I was expressing that through XLY. That was a minus 21% eyeball discount this morning, which is a negative 1.2 times on a trailing 12-month Z-score. So that was top of my list. I was quite active in that one today. I thought that setup was actually quite awesome. It was right at the top of the risk range from the ETF Pro product. That top of the risk range was 149. So we were kind of right there. Had a lot of great setup there with eyeball discount, and it had been diving, along with being at the top of the risk range on a trending basis, and seeing him hit. I was already kind of shorting it ahead of the Amazon RTA, and to see Coach kind of pull that trigger and hit that button. Just made me feel even more comfortable. So I actually sized that up quite significantly. It's kind of, for me, it's just north between mid and max at the moment, just from a sizing perspective. So just kind of keep that in mind. I think the other commentary there would be XLK, right? So XLK, two of its components are Microsoft and Apple. Two of its largest components are Microsoft and Apple, and they're currently in bullish trends, right? So it had kind of pushed higher, but really didn't get to the top of the risk range. Now, that's not necessarily a good thing or bad thing, but it did put in a new 1 month high and 3 month high. So just kind of being conscientious of that, and its underlying components. But you did have Microsoft put in a big lower high this morning. It didn't, where did it close at? Yeah, it closed pretty much right on the number. So the top of the risk range was 312. It closed at 3.31, and again, so that was a big lower high. I think just keep tracking kind of how how those risk ranges are kind of looking inside of the Microsoft and Apple. You get those every day on top of XLK. When you start seeing a number of kind of lower highs in a row, that's again, we're not really, XLK is a core short, same with QQQ, but we haven't really been back in the wood on those, and have certainly been preferring industrials, cyclicals, growth, profitless growth companies. So again, we were kind of went back to the wood today on a number of those in regards to like DoorDash and stuff like that. So I think those have been really well. I mean, XLI, XLF, those were all both down on the day. At least I believe they closed down on the day. Let's just double check that. XLI, XLF, XLE, those continue to remain. We're expressing energy really through XOP, but that was also down on the day too. So again, these core shorts are acting a lot better than the kind of than the chase that you're seeing in some of these larger mega cap tech names, and so that's definitely they're working well, and I'd be sticking with them. Industrials in particular is certainly probably at the top of my list. It had a negative eyeball discount this morning as well at -5%. And that was a negative 0.9 times on a trailing 12-month Z-score. So that's kind of run through the gamut there. I think that probably makes a lot of sense. Canadian dollar, just going back to FX, the Canadian dollar, it had quite the rebound, and back right at kind of the top of the risk range here. It flirted with the top end this morning. It didn't close up there. Closed at spot 7474. It kind of rebounded with oil a little bit, but it's really gone from kind of the low end of the risk range to the top end of the risk range. Still remains bearish trend. I think that's probably one of the best setups in FX land would be the Canadian dollar, and especially just given the weakness in oil and commodities in general. Commodities just continue to put in lower lows or lower highs and low lows really. So that setup, you can go and look at the Aussie dollar as well. The euro, again, the narrowing risk range, as I mentioned, in the euro, the USD, and the 10-year. Just keep a keen eye on those. When FX vol is sort of sub 9, which is also the trend level, that's where kind of expressing it more in the trade weighted basket, like a UUP, becomes a bit more challenging. But you're going to be able to kind of really sharpen your knife and pick some good opportunities from a cross standpoint, right? From FX cross standpoint, that Euro USD, although neutral on the page, it is kind of, as I said, it's sort of like just kind of hanging in there. That 110 level seems to be a really key, crucial level. So we're going to see kind of how it plays out with the outlook in Europe. Certainly some of the indices in Europe are kind of starting to lose signal strength, or pick up signal strength to the downside. I haven't quite turned bearish yet, but really bearish trade, not quite bearish trend. For instance, those top 4 shorts, I think if you watch the macro show, you know which they are. But there's a couple big ones like the CAC 40, aka France, aka EWQ. That one's kind of rolling up the list, and I think really I've got a keen eye on Europe in terms of getting back in there on the short side. They certainly, if you incorporate, I guess, some narrative or some stuff that's going out there that you hear, their inflation numbers, et cetera, it certainly ties well into that. But I like to stick, and we like to stick on the Notebook Review, away from the narratives and more towards the data and the fact that the real matter is that the Nowcasts are certainly backing up the kind of weakening signals there within the indices and the equities. So that's one of my top things that I've been just kind of slowly picking away at it as in the last kind of week or two on Europe, and been expressing that in a couple different ways. But yeah, so that's definitely a key one there as well. I think that's about it from my side. What else we got? Roland, you got anything on your side? just opening up questions. I see Other Side Asset Management out there. I don't know if he's George. Anyway, folks can just jump on. I've kind of run through the gamut. We can also just call it a day. It's a beautiful day out here. We can just go outside for a walk.
I hear that.
I mean, I'm excited. I mean, this stuff's. What's up? What's up, Mitchell? You're on mute, brother.
Can you hear me?
Now I can. How you doing, man?
I'm doing okay. How are you?
I'm great. I'm great.
You sound good. You sound all excited.
I'm excited. I'm excited. I mean, this setup's. Daily today is a gift, man.
I don't know if you ever interacted with him on this when he was on Twitter, but the old account Caffeine Addict used to point to divergences in the VVIX and the VIX as a very telling sign, especially when the VIX gets close to the low end of the range. He and I used to talk about it quite extensively behind the scenes when he was on, and we tended to find that when there was a very large divergence, something big usually wound up happening. Now, again, it's just something to note. It's not, something to pounce on. But, if you look over the past day, week, month, VVIX is up 5.5% today, 6.24 week over week, 16.9%, 16.9% month over month, while VIX got crushed today, right? So that divergence is not normal. And that just goes back to what you were talking about earlier in terms of some of these getting towards the low ends of their ranges and the setups with a lot of individual names at the top ends. So just something to note.
Yeah, and please don't. So again, Mitchell, I love the commentary, and you're right. For most of us who don't have, who don't track the vol like Keith does on each individual ticker, it's a great proxy. But Keith will tell you that it is just a proxy, and it's a made up product, or sorry, it's a whatever. It's a CBOE product, so take it with kind of a grain of salt. But it's off the shelf, right? So it's off the shelf. So don't go fucking asking Keith about it on the macro show tomorrow.
Are you talking to me or everybody else listening?
No. I'm just talking about generally in Hedgeye Nation, right? I don't want to. You said it hundreds of times with the VVIX. Like, he doesn't give a shit about the VVIX because he has his own vol, which is. But yes, Caffeine Addict is.
It is just one thing
Mitchell, this
to note.
is not a chirp. Mitchell, I completely agree with you, and it's something that I also saw, which gave me even more conviction to get short. So I use it, but because I don't have a vol like Keith does.
I love your legal disclaimer.
So Keith, if you're listening in, I know you have a vol. But
I know that too. I'm well aware.
Yeah,
it's just
exactly.
one thing to note.
Exactly, 100%, man. But it's it's a great call out, and yeah, and I mean, listen, and he's seeing it. I mean, he added He added like 4 shorts today. I mean, we got a couple longs.
Yep. But the longs are quad 4 longs, right? So the quads are
exactly.
XLP, it's Hershey's.
Yep. Yeah, he added the staples, consumer staples, and as I mentioned, kind of added some of the profitless growth type exposures on the short side, along with Amazon in terms of consumer discretionary. So I mean, it's he's certainly kind of building out the book in that way, and it makes perfect sense So I suspect he saw the same thing. Vol is increasing, while the actual VIX or the volatility of the underlying was decreasing.
Yeah, and yeah. I'm just being playful. Obviously, I know that Keith has his own vol, and this is definitely not something to anchor on. It's just one thing to note. I mean, you ran through the paces pretty solidly. I mean, you've got oil came off the top end of the range. You got gold hanging in on a month over month basis. XLF, XLV, XLI, XLB, XLE, XLC, all negative on a month over month. Volatility coming into low ends of their ranges. That proverbial beach ball. Top ends of their ranges on things. I mean, Amazon from the short standpoint, I think it was 1.1% over the top end of the of this morning's risk range. Obviously, he shorted. I think it's also important to note he shorted Amazon, but he didn't short Google. So I'm pretty sure Freebird is slightly changing his tune on Google, if I'm not mistaken.
Yeah, that happened a couple
So
weeks ago.
yeah. So it's just
It's also
important to note that
it's also been putting in higher highs. I mean, it started the week at Google had
correct.
a risk range of 101 to 108, and today was 103 to 110. So
Yep.
that I think
And
putting in those higher highs is a key aspect there.
I'm just calling it as a point out. So for everybody who looks at up down ratios, right? You have more of an up down ratio, or nearly as much of an up down ratio on Amazon as you do, close to, not exactly. Amazon is still greater than Google, but not by much, right? So, there's a reason why he went to Amazon as opposed to Google. So just if you're looking at, I'm just talking in general to everybody on, if you're looking at why he shorted one versus the other, just be mindful of the higher highs and higher lows in Google, and Freebird talking about a noted shift in ad revenue over the past couple weeks. So just something to keep out. So that's just something I noticed, something he didn't do that I noticed. So no, I think you ran the paces pretty solidly.
Google was also up on pretty significant volume. Amazon also had, again, I look at it from a 5-day average volume at time basis. So it was up as well. I mean, in terms of like versus the average 5-day volume. But if you kind of look back in time, the volume was kind of average. I'd say average on Amazon and went above average on Google, or significantly above average on Google. So again, it's price, volume, and volatility, and therefore keeping a good look on all three of those. Again, that was kind of one of the reasons why I was really expressing it through XLY because that volume was much more in line with kind of average volume, and it really couldn't hold. So if you look at kind of where it started the day on XLY, it really kind of tried to get back there, but it pushed up towards like 149.54 range, or call it 149.50 range, and really couldn't hold it this morning, right? So it really kind of, although it did rebound, it really kind of just kind of closed around 140, just 148 spot 35. So again, just didn't quite make the same push as like the Qs and SPX did, which the Qs kind of, anyway, yeah. So those are all little things that I was kind of noticing as well.
You picked up on pretty much. I mean, you were seeing a few things that I wasn't. Like you even ran through the move, which was down 6.22% day over day to 125 and change.
Mm-hmm.
I think trend this morning. You said was 118 and change, right? So
116.
Everything's kind of moving. 116. So everything's moving in the right direction.
118 is the most recent like low, or like it's the 1 month low, I believe is what it was. 116 is 116 is trend though, just to be specific.
Trend.
Yeah,
gotcha. Yeah, all good.
Again, I mean, these, like, in terms of, I'll just reiterate kind of like the cyclicals, the industrials, the profitless growth companies, bad balance sheets. These are all ones that we kind of want to be piling in on the flip side of that, especially with VIX in the teens. You do want to have longs in the book, right? So the consumer staples have performed very well in the last 3 months or so. Healthcare has performed well in the last utilities have performed well in the last 3 months, up over 5%. Communications, so again, XLC, but Freebird likes the Meta and that, and T-Mobile and that kind of stuff. So I mean, those have performed well as well. I mean, consumer staples XLP are up almost 6.5% in the last 3 months. That's in comparison to XLK, which is up 7.9. So, those are kind of right in lockstep with that. So again, So just calling that out as well. It's Staples definitely performed well. Some of the
I think it's important to note in his call out. When he talked about buying in his notes, we always talk about how his notes are often more important than
the coaching
the
notes, you
actual
mean?
itself.
The coaching notes in RTA, yeah.
Correct. So, first he mapped out the XLP, pair against short Amazon, right?
Yep.
But then at the same time, when he went to the Hershey's buy,
Yep.
right, he was very specific, and he said, something to the effect of, just like I did with, healthcare last week, I went to the sector and then I went to the individual stock name. So, it's one of those things where I don't think he can do a better job in coaching you through your feelings. Like if you were having trouble executing on XLP, coming back on the individual stock name, he's saying, come on, get off the horse, put some longs on. You may not want to because you think everything's going to fall apart, but at the same time, XLP is a good quad four performer. Get it on the books, right? So just those coaching notes are very, very important for people to understand.
Yeah, and just to go back to my commentary on the VIX in terms of it's putting in a higher low, but the top end of the risk is still inside of 21. So, even if we get the move higher and we do start to, kind of the trend becomes to the upside, you're still talking kind of the low end of the chop bucket or the middle to the bottom end of the chop bucket at the moment. So, just again, being very conscientious of all these things, but also noticing the particulars in terms of when you are getting higher lows. So, versus a month ago when it was kind of the opposite, right? You still kind of had the top end chop bucket, or top end of the risk range was probably closer to kind of 26, 20, 25, or certainly higher end of the chop bucket. And that low end of the risk range was kind of in the high teens. So again, these little nuances, these little particulars are what you got to be paying attention to, but still having these longs on the book. And being kind of conscientious of how to kind of trade them, but to your point, sticking with things that are quad four longs like Staples, healthcare. Pink is bullish trend, utilities bullish trend, Staples are bullish trend, GDX is bullish trend. There's lots of opportunity out there to have some really good quad four longs inside the playbook. GDX is up like fucking. It's up over 17% in the last 3 months. So that's been that dog will hunt.
Yeah, actually, 3 months, 27.23%.
GDX.
Yeah, am I wrong in saying that?
I think it's 17. No, was that this week? Might have been this weekend.
I don't know. I have day over day at 77, down 71 bips, down 113 bips week over week, down 25 bips month over month, up 27 3 month. I could be wrong though. Maybe my stuff's not updating because I'm in the car.
I don't know. Yeah, it doesn't really matter. It's up a lot.
Yeah, agreed.
Yeah, or maybe you just need glasses. That's 17.
We've talked about that. I do need glasses.
Yeah,
I need to get them.
It goes really well with that Buick you got. It's a nice ride, dude. It's a nice ride, but you knew I had to just give you a little jab there.
Yeah, you could judge all you want. I enjoy it. I'm an old man.
They're not judging. I know you're.
Oh, no. That's a Shaquille O'Neal vehicle. I'm sorry, but that Buick is a gorgeous truck.
Listen,
Takes a big man to ride that.
I don't need anything fancy. This thing is bad enough for me.
Oh, it's badass. It had like a massage. It had a massage feature in the front seat, Roland.
Yeah,
like
I can't complain.
We went like 10 minutes to lunch. He was like, if you want, you can put the massage chair on. I was like, what do you mean you got a massage chair? But boy, did that feel good after that was Saturday. So after like 3 days at Hedgeye Live, My lower back is a little tight.
The best part is
Lack of
the,
sleep, putting in some shifts.
the best part is not even knowing that I had it when I bought it.
Yeah, I know.
A little surprise.
All right. Well, this has been good. Why don't we, guys? There's lots of
Open it up. Let's
amazing faces out there. So come on up. All right. Let's get after it. Let's answer some questions. Let's talk about your portfolios. If we get into narratives, I'm going to kick you off, though. Just letting you know. This is there's a lot of other spaces that will be preaching about narratives about CPI and inflation and all that other bullshit. That's not what we do here. Oh, here's one thing that people I guess don't get too scared. I'm a nice guy, so if you didn't watch the macro show yet this morning, huge call out. Um, a huge call. Hey, Mitchell, Laura Keith just texted me. She said, "Don't be trashing my buddy's ride. That thing's a beauty." Yeah.
Because Laura Keith is a badass.
She is a badass. Laura Keith is a badass. All right, so two quick call outs. One, which again, this is how good Mitchell is, gets a shout out on the macro show from Coach. Great tweet yesterday, buddy, on NFIB small business optimism. Came in at 89, which is the lowest number really since that 2008 to 2013 period. Again, a lot of people obviously go it crashed going into 2008, but it was actually interesting looking at that in terms of really kind of hovering around that level, that 2008 2013. But point is, significantly lower, even more importantly, significantly lower than the 2020, aka COVID lows. So that's a big call out. Great work, Mitchell, there. And then secondly, on the inflation and GDP number. So if you haven't watched that macro show yet from today, definitely go back and check it out. It's in like kind of back third. But really, the call out is that GDP nothingness in the next three quarters, so Q3, 4, and Q1 of 24, really kind of that GDP on a year-over-year basis coming in around 1 to 1.5. So again, just kind of like really nothing burgers in terms of growth on the back half of the year as we get kind of out of Q2. Q2 has the highest conditional probability of a quad 4 and a deep quad 4. But again, we're seeing kind of quad 4 and quad 4 in Q4 and quad 3 in Q1 of 24 at the moment. But as these kind of numbers kind of start to roll in, they will get updated and things will shift. But just wanted to kind of call those two things out. I thought they were very important in terms of small business optimism. And Mitchell, again, great call out yesterday in terms of reminding everybody that 99+% of the majority of businesses in the U.S. are actually small businesses. So that optimism level is critically important. I just realized that Drago sent me an updated macro themes. Let me just make sure that my Nowcast, that those numbers are still accurate so that I'm not misquoting. 1 second. Where are we at? Yeah, basically 1.41 in Q3, 1.31 in Q4 on the year-over-year, 1.09 in Q1 of 24. So so I was right. It's about 1 to 1.5, but really that number is probably 1 to 1.40. And yeah, got it. Okay. Yep. So those numbers are right. And from an inflation standpoint, our nowcasts are really kind of in and around 4% for the next 4 quarters. So we got a nowcast of 4.26 here in Q2. And really that, we're not seeing, even though consensus is going all the way down to 2.80 in Q1 of 24, we're seeing our models really predicting kind of still north of 4 at I think Q1 of 24 at 4.16%. So again, these numbers that's certainly we're certainly differentiated there on the consensus side in terms of inflation. That would be CPI on a year-over-year basis. We're kind of right in line here in terms of kind of right around 4.25 we're around 4.25, 4.26, and consensus is at 4.20 currently. So that's updated, Drago. Those are updated numbers as of this afternoon. And so we're kind of in line with Q2 23 here, but certainly differentiating as really kind of consensus has it stepping down from 4.20 really down to kind of just sub 3%, 2.80 in Q1 of 24. So just wanted to call that out. I think that's a big thing to be conscientious about, and certainly will be impacting kind of our Nowcast model in terms of what we're seeing on the board on the out years. But yeah, our conditional probabilities are kind of sticking with what I was saying there. Let me just triple check that as well. Those didn't update. Yeah, quad 4, quad 1, quad 4, quad 3. Perfect. Yep. But that quad 1 number is kind of a coin. Yeah. All right. Pokey. Jay.
Gentlemen,
Jason.
Great to connect again. I only have one thing, but I just wanted to say, like, everyone at Hedgeye Live did a great job. Robert, Mitchell, everyone else. It was great meeting you guys, but it was just such a wonderful program. Like, everyone did such a, it was very well done. The access and the opportunities, they were incredible. I'm still working through the 444 slides that we got. The data itself makes it worth going to the conference for anyone that might be on the fence for next year. The one thing that stood out for me, and this isn't from the weekend, but from the past few days, and I apologize, I'm not at my desk right now, but if you look at a number of the risk ranges, especially like the low end of the risk range on things that popped today, you can see the past few days. Look at the bottom of the range. It really snapped up. It pretty dramatically in things like Microsoft, Facebook over the past few days. Even the S&P, the low end's been trending higher. Probably shouldn't say trending, but it's been sliding higher over the past couple of days. I really think that I'll be fascinated. I'm really going to be watching the next few days to see what the high end does. This has been on such low volume. I want to see what the high end of those risk ranges, if they really get pinned or if they start to come into.
I think. Hey, Jason,
Yeah.
what's going on?
Good.
Sorry, Rob.
Go ahead.
Go
ahead, Mitchell.
Go ahead.
No, go ahead. Go ahead.
I think that's just indicative of a consolidating market, right? The vol is compressing. The yields are compressing right now. The ranges on the yields are compressing, as Keith noted this morning. Range on the dollar and FX is compressing. So you've got ranges that are compressing. It's likely a sign of consolidation. Now, which way it breaks is, I guess anybody's guess, if you will, but that's where the quads come in and that's where the signal comes in, right? So yeah, definitely a consolidation, definite, notable point out. Keith noted the risk range, the top end of the range on Microsoft coming down. Ironically, this morning I noticed that the bottom end coming up the past couple of days as I went through my spreadsheet. So I'm seeing the same thing you are. I'm just curious as to which way it breaks, and I would note it as a consolidation.
Yeah, that was going to be my point too, Mitchell. Is good, great call out, Jason. But really, in the last month, if you look at the VIX, we've kind of closing prices have, for the most part, been between kind of like 16.5 and 18.5. Again, I'm rounding out numbers. So those kind of pricing on a trade basis, which is what those risk ranges are, on a look back window, those are going to influence the range, right? So I think those are kind of playing. Yeah, those are bringing up the lower end of the risk ranges, and also if you kind of think about like where Microsoft has come from in the last month to 3 months, there's a huge gap higher there, right? It was trading all the way down at 240 just on March 2nd, right? Sorry, 240, closed at 251. So, but the day before that it was closed at 246. So call it rounded out at 245. So, those are that's the 3 month lows are around that ballpark. And now we're up at 312 closing today. So, that big move on in terms of like where we've come from, and certainly now on a 1 month basis, you've got that gap higher post earnings because the day before they reported it closed down at 275 and a bit. And again, now we're up at 312. So, when those as those prices kind of start falling out of the look back, it does impact the ranges on both. If it was conversely, right, you'd be seeing the top end of the range really, basically fall or come closer to price, and that's kind of what you're seeing here too. Is volatility is staying relatively, within a band on the last kind of 15 to 21 day basis. And then in terms of the pricing in this particular security that we're talking about, Microsoft, for the last 10 days, it's kind of been, basically 305 to now 310. But prior to today, it was really like 305 to 308 type thing, 309. So again, this, anyway, but that's but yeah, good call out. I think you're, the narrowing risk range, for something that's in like a bullish trend though, and Mitchell, good point in terms of like a higher low, but really it's something in a bullish trend when something makes lower highs on multiple days in a row, like Meta, for instance, right? 250 today, 255 yesterday, 257 on Monday. What was it? 258 on Friday. So that's we're coming from basically 258 and down to 250. Again, it's bullish trend. We like it. Freebird likes it. But when you're seeing that, again, it's just one of these things where it's perhaps sort of the signal kind of telling you, okay, it really needs something to change, right? So it needs either an up move on volume, right? So you kind of need price and volume to sort of go hand in hand, and then decreasing volatility within that component in order to really try to ramp higher. And it has that capability today, right? I mean, the most recent highs were from last week on Monday, which it closed at 243.18. So even if it hits the top end of the risk range, even though it's come down, it's still 250, which is higher than that number. So that would put in a new high, a new 1 month and 3 month high. That is a really good thing. I'm just kind of communicating, these lower highs though in a bullish trend are, I'd say kind of like slightly more significant than the the higher lows, and that kind of thing. The higher lows really just mean that you're not going to go down as much. So when on a down day or on a red day, if you're seeing kind of higher lows in a particular risk range in a bullish trend, it has a higher probability that it's really it's possible it doesn't get all the way down to the bottom of the risk range, I guess is the way to think about that. So because your probabilities are increasing that you're basically things are going further higher, right? So that's kind of, I think, hopefully I explained that well, but yeah, that's where I think the lower highs in some of these bullish trends like Microsoft, Meta, Amazon had a higher high, so that's, yeah. But Microsoft and Meta in particular, Apple was kind of flat today, but 175. So it'll be interesting to see if that top of the risk range comes down a little bit as well. Nvidia had a slightly lower high. Same with Netflix. That signal is breaking down a lot, actually. Netflix. I can't believe I didn't call that out. Yeah. No, Netflix put in a higher high. Sorry. My bad. But it has broken down in the last couple of days. Anything else on your brain there, Jason?
No, I'm just I'm starting to get a little interested in China. Some of the stocks are coming down towards the bottom of the range. I know the signal is bearish on it, but if you listen to Felix, he's pretty positive looking into the next 3 to 6 months. So I might be starting to try to front run and dabble a little there.
Yeah, there's lots of different ways to play the game. I'd say like Hong Kong is bearish. The Shanghai composite still is bullish. I did put in a lower low and a lower high today, so just be conscientious there. You could get a little bit further consolidation in that risk range, or kind of that low end of the risk range might go a little bit lower, I guess, to the point of what I just said. But Jason, I Felix has been absolute, alpha generating machine, and a lot of his individual securities look a lot different than the indices, right? A lot different than Hong Kong, a lot different than Shanghai. So you're definitely thinking about it the right way. I know his room was quite packed on the 2 sessions that he did last weekend, and so I think hopefully a lot of you that were there at Hedgeye Live were able to sit down with him or pick his brain and go through some components there, because he's got just did a new black book on Monday. I think it was Monday. Yeah, Monday. And I mean, that guy's got it. He's been on a heater, as they might say. Yeah, Kospi is the other one, I think. Again, it needs to kind of hold trend in here. Coach reiterated this on the macro show this morning. He's been kind of talking about it the last week or so. But that would be one as well that's kind of on the short list in terms of potentially getting interested. So if you want to express that, that's EWY in South Korea. And it's been kind of consolidating a little bit less, kind of 10 to 15 days here. So again, just kind of put that one on your radar too, EWY. And yeah. All right, we got any other questions up there in the crowd? Again, happy to chat through anything. All right. Well, I don't really have much more, so we can just wrap up. I think this was a good one. We'll be back next week, same time, same place, 4:30 Wednesday. Beginner's Guide will be on Friday, so that'll be at 11:30 on Friday. So keep an eye on that. We got Muni Guy maybe coming in. Never mind. People might not want to let me go. What's up, Trillion?
Hi, guys. Thanks a lot for having me up.
Yeah, man.
I just had a question. The Jets short did quite well. I'm expressing it through Air Canada, so that was great.
Yep.
But I had a question on Canada Goose. It's been going up quite a bit there for the week or so, and with earnings coming up next week. I was just curious as to your thoughts on how to play that,
Yeah, good question. Let me pull up the short interest. I actually haven't looked at Goose up recently. Give me 30 seconds here. I'll pull up the short interest. I know. Sorry, Goose. Canada Goose. What's the short interest again? Short float. Yeah, that thing's got a 30.74% short interest in it. So that is a significantly short stock, which is potentially why it's made a new high, new 1 month high and 3 month high yesterday. So with it doing that, again, if you have a position on from higher, maybe kind of with the catalyst next week, maybe have it, again, a minimum type sizing here, but with it sort of putting in, a new high yesterday. I don't have the signal from Keith, but that would not be currently one unless you've got really high conviction in the earnings next week. But I would really, if you got that on, again, it would hopefully be at kind of a min size at the moment. If it's bigger than that, on a down move, I'd probably be kind of trying to risk manage that into the event next week and go from there. But let me just.
Yes, I did. I did actually incrementally add today to it.
Okay.
That helped substantially. But as they say, the envelope risk on the earnings. But the analysis from the retail side with the high inventory, I am fairly certain, that they're not going to beat.
Yeah, Brian's definitely still short the stock, and let me just pull up, make sure I see how high it is on his list. Sorry. He's definitely it's number 2 on his list, so he's definitely short the stock. Don't get me wrong. I'm just telling you from like a signal of what I'm seeing on the page, right? So like,
of course, no, that's why I'm asking. Thank you so much.
From a risk management standpoint, but I again. it's a core short of Brian's, so having some on, that's why I kind of said like a minimum to maybe a mid size going into it. But yeah, I mean there's definitely let's just put it this way: I've seen better signals, right, to confirm the the kind of outlook going into it. So if it really starts to break down here into earnings next week, then I would change my tune. And you certainly saw kind of put in that new high yesterday, but couldn't really hold it today. Tried to. And it kind of had a bit of a down move on some volume as well, which is good. But again, this is typically going into an earnings event, kind of trying to risk manage that position. Same thing with like the CPI today, right? We got PPI tomorrow and jobless claims tomorrow, and we were kind of risk managing our fixed income positions going into today's print on the inflation side. And did so again by selling some of that, IGD, TLT this morning. Even some of the gold GLD as well, right? So, that's I think the risk management piece is key here. Again, Goose is a core short of McGough's, and that's a good thing. But it's one of those things where it's like I got no clue. I got no clue what they could print tomorrow, and
Yes,
with
if
the
I may
short.
just
Sorry,
commend,
next week, and with the
if I may
short
just
float.
commend the Aritzia play that happened as of
Yeah,
late. So Brian's on a really really big roll, and I just wanted
yeah,
to compound
totally.
that through the Goose. Right, I said, wow, that was incredible. So
Totally, but you also got to understand that you're there with a lot of people, right? You got a 31% short float. So if that print is not as bad as expected, and I know that's like a really poor, like it's whatever, estimates are estimates, but if it's not what the street thinks it is, Trillion, you could that you could have a lot of folks get a tap on the shoulder, right? And that thing could be $30 before it's 20. So just keep that in mind.
Roger that. Thank you so much,
Yep,
guys.
you got it, boss. Anything else, man?
No, that was
Okay.
that was everything. Thank you so much.
All right, cool, man. Yeah, keep up the good work, Trillion. Muni guy, you stepped up, bud. How you doing, man?
Hey, Robert, how are you?
I'm good, buddy.
I'm having to work. My golly, I'm back and I'm having to work.
Oh man, tough life.
Yeah, Jesus. No, a couple things. I did a tweet. I saw you retweeted it, where I asked everyone kind of like, "What are you earning?" Just on your idle cash, and kind of did a compiling of all the responses. So appreciate everyone. Sharing what platform they're using to trade and go along whatever it is that you're doing, and kind of making sure that we're all earning fair market value on the money market side. But I just wanted to get some kind of color on the rate side. So the SIFMA rate, the variable tax exempt that we monitor, it peaked and now it's starting a drive a little bit back down. So it's at a 304. Last week it was a 345. I think the week before that was like a 380-ish. So it just continues to do a little bit of a roller coaster, which I find interesting from a flow perspective. On the CD front, it looks like we've kind of plateaued right here at one-ish year CDs at a 515. I know that we were kind of up at that 530 to 540 range at one point, but it seems like we've plateaued a little bit at the 515 mark from what I'm seeing online. And then I noticed on the U.S. Treasury side, you can get a 5-month at a 5.018. So just a reminder that U.S. Treasury bonds, the interest is exempt on state income tax. So if you're kind of in that California, New York high income tax on the state side, that might be something that you think about as you make kind of decisions there. And then the muni front, I did that whole space and we talked about 4 coupons to yield 4.25, and then playing the long game on the interest rate cycle and getting those bonds to price for the call date. We saw rates go from like 4.25, where I was buying before, all the way down to about 410, 405-ish. And I just looked, and there's an offering of high AA grade at a 415 right now. So you divide that by 1 minus your tax bracket, federal and state. But just looking at the highest federal, it'd be a 6.59% taxable equivalent yield. So kind of watching to see if we don't see that 4.25 mark again. Some of it's state specific, and I can get to that in a second. But two things that stood out to me this week. So I sold 26.7 million on, I think it was Tuesday, and it's high grade geo, 3 years, very short. We got 10 bids, which is kind of a lot. So very high subscription. So we're still seeing, really no issue on high grade local government type munis. And then I participated in a rating call today where one of our clients thinks that they deserve to move up to AAA status. And just to give you kind of an idea and kind of how we approached it, the IRS released some figures, and there have been a number of articles on it, but it tracks people's filings and specifically high earners. And the gist of the information is that there's this migration of high earners to lower tax states, and so the biggest winner was Florida, and the states that we were looking at, the state that we were dealing with, came in ranked number 5. But when you break down the data, it's actually very concentrated in certain areas, and they were a really big winner. And just to kind of give you an idea from a collections perspective, on a countywide basis, the current year will end June 30th. We're looking at an increase of 5.74% in collections growth. And then in talking with the assessor for this next tax year, we're looking at a growth of 12.5%. So, when I hear people talk about munis and Meredith Whitney moments and things like that, you really need to pay attention to what's going on in the region in which you're buying. And there are winners and losers right now. There definitely will be some losers, but there definitely will be some winners. So as we, in our analysts, kind of dive into this IRS migration information, I just started working on it this week. I think it's going to be pretty interesting to see not necessarily what states are the big winners, but what counties are the big winners. And then within those counties, you have issuers, you have schools, you have cities, the county themselves, you have special purpose districts. So there's all different kinds of interesting things going on right now with this post-COVID migration, Quad 4, lower tax states, just a lot of different things going on the credit side. And then lastly, Disney reported, and they didn't come in terrible, Robert. I love Disney. It wasn't terrible, but could have been a lot worse. But they're looks like they're down a little bit after hours. So today's one of my favorite days to watch earnings. I don't really watch earnings, but Disney fan here. So that's really it on the rate side, and what we're seeing just kind of on a real life basis in the clients that we deal with. We're not seeing any stress at all.
That's great. No, it's good to hear. And I know Nancy Davis kind of made some commentary on Friday and the macrocosm in regards to munis, but and I know you listened to it, so it was good to get your take on it in terms of a lot of it was more towards like the commercial real estate and other things, and again, like basically to your point, kind of the lesser quality muni bonds, right? And you've been very clear in regards to, especially in our conversation that we had. Well, that's probably about a month ago now, maybe not quite that long ago, but in terms of like how where you're very selective. Let me just put it that way, right? You're very selective in terms of like what
very
you,
much so. Very much so.
Yeah. Which is one reason why you don't really like many of the structure, kind of the the pre-existing funds out there, and that's why you create, and you've been actively managing your muni portfolio for income. And I think that's another big piece too, right, Brian? And again, I'm kind of stealing your words, but managing, thinking about it from an income generation standpoint down the road versus an investment standpoint. Two different thought processes there. And again, so if you I won't have you rehash your thought process, Brian. But if you are interested, for anybody who's listening, if you're interested, that podcast is available, and that conversation I had with Brian is available on all of Hedgeye's channels, whether it be YouTube, podcast, Spotify, Apple, whatever you prefer. Just go look for that. It's Hedgeye and Friends. It was a great discussion. So thank you again for spending the time with us to do that, buddy.
Yeah, and I do have a rates trade on.
Oh,
yeah. So I have EDV, and then that one fund, that BMN fund. I'm actually playing that as a trade as well. I've got a bond that's maturing, and so I'm taking a larger position on it to actually trade it. So, as you alluded to, there's buying rates where you want the income stream, and then there's trading rates. And so I do got a trade on. I got a little trade on there.
Boy,
a little aggressive, But on the CRE thing, I've been fascinated by the CRE thing, and I got into some, Twitter jousting a little bit on the saving these regional banks and all. When you look, we've had 3 bank failures, 2 in California, 1 in New York. That seems very regionalized, right? And so I think it's going to be a struggle to short municipals on the CRE piece, as opposed to finding, longs, good credits that aren't in there. But I do find that piece a little bit fascinating from what Nancy Davis said, that there are some municipalities that do rely on, CRE tax revenue. And it won't be an immediate thing, but it's when that property gets reassessed, and it doesn't get reassessed overnight. But when it does, the tax bill goes down. And if there's a default, then the bank just takes it over and makes the tax payment. So we saw that in 2008. But there is a longer process in which you can see some stress. And I'd be interested, as we kind of get into these regional bank discussions and, who's going to zero. Pac West looks like they're kind of up next. It just seems real interesting to me to kind of see where those CRE pockets are, and then look at it from a fixed income lens as well. But I think that's what she's alluding to, and I think there's some merit there.
Yeah, and I know you texted me in terms of it can take time, right? Because if it is getting repossessed by the bank, they're going to be paying those tax bills until basically they either sell off the property at a discount or figure out the kind of foreclosure process, all that kind of stuff, right, Brian? So this won't be kind of an immediate term component. And that Nancy Davis conversation was fantastic. She ran through kind of the both of her funds, and she and Keith talked a lot about kind of the different components inside of fixed income and how she thinks about it and how she structures her products. But yeah, no, I thought that was really interesting, right, Brian? That you were texting me, you were reminding me that back in that 2008 timeframe, that tax bill didn't really hit the munis for a number of months, if not kind of a year plus, because of the structure, right? Because they were paying the tax bill until to your point, it got sold at a lower level.
Yeah, we didn't, and quite honestly, it was a moment for us too, as financial advisors to municipalities. We hadn't seen something like that, and it feels kind of like this recession, right? It's just a slow grind. It's sort of the same thing, which is kind of a slow grind. But I'm just, quite honestly, as I'm working through this week, I'm just really amazed at what we're seeing in real-time tax collections right now, just on the local government side in a state in which it's a winter. It's just very robust, and we know it's going to plateau. And every year we say the same thing, and it hasn't yet. But it's good for them and good for their communities.
Yep.
So
awesome.
Appreciate it, man.
Yeah, buddy. Yeah, thanks for the update. Appreciate it as always. Hey, Palmer. You jumped up.
What's up, bud?
Man? I'm good, man.
I think I finally recovered from Saturday night. So slept 10.5 hours last night or night before last.
Yeah. Yeah.
Yeah. Hey,
ditto. I finally got back to my own bed. I stuck around. I went to the office the last 2 days, and so I came home yesterday late, early evening, and it was nice to be back in my own bed after kind of
Yeah,
a week away.
I bet.
Yeah,
Hey, I actually had a question for Brian if he's still hanging around there.
I think so.
Nancy Davis said something in a breakout session. She was in Rob's session first day, and something to do with something to keep your eye on with regards to. I thought she said something to do with SOFR. Something was supposed to reset on June 30th, and it had significant impact on commercial real estate. And I think I asked Brian this in a Discord chat, but I don't know that I remember him responding, or I missed his response. Brian, you have any idea what she was talking about, or am I mishearing something? Or
When I responded to you, I hadn't listened to it, and I still don't have an educated answer, but I do know that there's some discussion about LIBOR ending and everything converting over to SOFR, and so I don't know if that's what she was alluding to or not. But I haven't seen anything other than a discussion that, and we're running into it because we're refining a few loans here and there that still reset off LIBOR, and so I know it's still being utilized. But that might be what she was. It's the only thing that I've run into that kind of has a date I know that's coming up. But again, I don't. I'd have to go look it up and see what day LIBOR is officially supposed to be turned off.
okay, yeah, like I said, I didn't get it written down, and we were really talking about MPW at the time, and so anyways, okay.
Yep, man. Take care.
You too.
Do you have anything else, Andrew? Or that was about it?
No. I just feel like
All
watching
right.
this market's like watching paint dry right now. One of these days it's going to get more interesting.
You like? So you're saying you like VIX 32, eh, buddy?
I like VIX 32, especially the way I'm positioned.
You're projecting. You just got to do what the signals are telling you, right?
Yeah, that's right.
But yeah. So we'll end on that. We'll just kind of as a reminder, just regardless of what we think might happen on the market, that's what the risk ranges. That's what the signals will help guide you through. Just make sure you kind of doing your best to track that price, volume, and volatility. It will help guide you to try to make better decisions at the bottom and top end of the risk range. But as I said, we'll be back here this time next week. PPI is out tomorrow. Same with jobless claims, so keep an eye on those. And yeah, we got what do we got? Yeah, so then we got beginner's guide on Friday. And then we'll roll into the weekend. So I hope everyone has a great rest of the week. Keep setting up that portfolio. We are seeing that recession risk continue to rise, and really inflation kind of the story of last year. Although if consensus keeps moving their numbers lower, inflation may be a story of this year too, us versus them. But for right now, just keep your focus on kind of the recession risk rising. And these earnings numbers, that was something I didn't touch base on actually, so we can end with that. But as of this morning, 450 out of 500 S&P companies have reported plus 4.22% sales and minus 3.23% earnings. And out of QQQ, so the Nasdaq 100, 79 of 100 have reported plus 4.45% sales growth and minus 8.5% earnings growth. So you're definitely seeing that earnings risk happening in Q1, and with a deep quad 4 with a high conditional probability in the Nowcast model, it's very possible that you're going to see those numbers continue to get a lot weaker. So we'll leave you with that. Hope everyone has a great rest of your day, and we'll see you soon.